It's important to understand the risks before we start spread betting, in particular how we calculate our outlay and the potential additional costs should a trade go against us. Spread betting is a form of margin trading, also referred to as leveraged trading or gearing. This is where our initial outlay is a percentage of the actual trading amount, but we still get 100% exposure in the market. The initial margin is the deposit required to begin trading. The size of this margin is dependent upon who we trade with and also the type of instrument we're betting on. With NatWest, the initial margin typically ranges from between 1 to 10% of our proposed trading value. And it's important to monitor the total margin on our trading account to make sure we have enough funds to cover our open positions. As with any form of investment, the aim is to maximise profits but minimise risks. One way is by using a controlled risk bet, CRBs, which carry a small premium. A CRB ensures that our trade closes at the price we requested, even if the market moves right through this level. Okay, let's look at controlled risk bets. When we open a trade, we can decide the price at which point the trade will be automatically closed to minimise losses, and this is called a CRB, also referred to as a guaranteed stop order or a GSO. For example, if we traded on the BP shares at 435 pence at £10 per point, and when opening this trade we requested a CRB of 425 pence, then if the price of the shares fell to 415 pence, the trade would have been closed at 425 pence. Now, if we consider the following two spread bets, we can see the difference in potential costs or the bet's losses with and without a CRB. We buy at a share price of 435 pence. We don't take out a CRB. The share price drops to 415 pence. We decide to stop trading. Our loss is 435 pence minus 415 pence, which equals 20 points. 20 points multiplied by our £10 stake equals £200. Therefore, our total loss is £200. Now, using the same example but with a CRB, we buy at a share price of 435 pence. We take out a CRB at 425 pence and the share price drops to 415 pence. Now, this is when the CRB automatically stops trading at 425 pence. Our loss is 435 pence minus 425 pence, which equals 10 points. 10 points multiplied by our £10 stake equals £100. Therefore, our total loss is £100. There are three other ways to minimise risk: stop loss orders, limit orders, and one cancels the other orders, also referred to as an OCO. Let's take a closer look at stop loss orders. Using a stop loss means our open position will automatically be closed if the market moves against us. Stop losses can also be used to lock in profit. If the market moves in our favour, we can move our stop order with a prevailing price, which locks in profit if the market suddenly starts moving against us. Stop loss orders can be used to limit the trading risk and are an essential part of disciplined trading. Using stops mean we are automatically taken out of a position if the market moves against us, which basically limits our loss. So, how can we use a limit order to manage risk? A limit order lets us predetermine either a price higher than the current price at which we wish to sell or a level below which we wish to buy. This means we can predefine the level at which we want to close our position and take our profit, or the level at which we want to buy below the current price of an instrument. For the stop loss and limit orders to be carried out, the instrument has to trade at the particular price we requested. One thing to remember is that sometimes during fast-moving and volatile markets, our stop loss will be triggered at our chosen level, but our order could be filled at a lower price. This is known as slippage. However, a controlled risk bet eliminates slippage. It's also important to remember when we place a stop loss or a limit order, if we close our trade without using our stop loss or limit order, then we must also close any outstanding stop losses or limit orders. Stop losses are an excellent method of managing risk. However, they may stop us trading early if the market we're only trading in has only temporary lows, but then goes higher. Limits and stops don't have to be set up with every trade. However, if you're a beginner, it's suggested that people use them. Okay, finally, let's look at the one cancels the other orders, OCO. One cancels the other orders offer a number of advantages for those wishing to get in and out of the market without having to watch it constantly. An OCO is the combination of both a limit and a stop, and it can be used to take a profit if the market moves in our favour or to limit losses if the market moves against us. For example, we traded on the BP shares at 435 pence at £10 per point, believing that the price will rise. We want to take the profit if the price peaks to 460 pence, but at the same time we want to limit our risk, so we set a stop loss sell at 420 pence. If the price falls to 420 pence, the stop order sell is triggered. The sell is executed at 420 pence and limit sell is automatically cancelled and our bet is closed. Therefore, our loss is calculated by the opening price being 435 pence, the closing price at 420 pence, with the difference being 15 points. Our loss is £150, and this has been calculated by the 15 points being multiplied by the £10 per point stake. If the price rises to 460 pence, our limit order sell is triggered. The sell is executed at 460. The stop sell is cancelled and the bet is automatically closed. Our total profit is calculated by the opening price of 435 pence, the closing price of 460 pence, with the difference 25 points. Therefore, our profit is £250. Now, this is calculated by the 25 points being multiplied by the £10 per point stake. So, what other ways can we manage our risk? Well, it's safer to trade in a diverse range of markets if we're opening more than one trade at once. Trading an index, for example, may be less risky than trading one stock, as our exposure is spread across a range of stocks that make up that index. It's also good to monitor the market we plan to trade in, as well as any other markets that could have an effect on our trades. Also, regularly check any open trade and its price. We suggest doing this several times a day. So we've talked about methods to manage risk when spread betting, but please do join me in the next module to find out about the NatWest Research Centre.